Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a look at a different aspect of the craft and consider if the lessons taught by the man widely considered to be its founding father can help shed light on the problem at hand. In this episode, we should be taking a look at something very much in the news right now. That is, what effect trade wars and other political turmoils have on the ability of value investors to profit from their trade. We shall consider what we can learn from past market upheavals, as well as look to see if Graham had anything to say on the matter. So without further ado, let's get right on with it. As ever, kick back, pour yourself something caffeinated, and prepare for another lesson in value investment, as inspired by the man himself, Benjamin Graham. At the time of recording, financial markets around the world have entered one of their regular periods of amateur dramatics, prompted by the President of the United States threatening and implementing trade tariffs on a number of countries around the world. Stock markets have yo-yoed on the latest words and actions of the world's most influential man and his acolytes. Whatever your politics happen to be, most will surely concede that the next 4 years could very well be bumpy ones on the stock market. It is probably the right time then to recall previous periods when we've been faced by unpredictable political conditions and consider how the value investor has fared during these periods. The first thing to say is also the most obvious. Participants in the stock market absolutely detest perceived periods of uncertainty. I say perceived quite deliberately because almost by definition, uncertainty stalks the markets at every moment. So to be clear here, what we are actually talking about are periods of heightened uncertainty. It must be said that periods of particularly heightened uncertainty are far from uncommon on the stock market. Previous to the current unpredictable political conditions, we were faced with market tumult in the aftermath of Russia's invasion of Ukraine. In this case, markets hated the fact that they could not predict and therefore price in the knock-on effects the war would have on the international economy. How long the war would drag on, what effect the sanctioning of Russian energy would have on global inflation, etc., etc. Similar factors came into play with the Israel-Hamas war. What would a regional conflagration mean for fuel prices, and how would this affect the economy as a whole? Ditto the unknowable effects of the COVID crisis on the global economy. In all these cases, the stock market did not have a clue what this meant to them, and therefore we saw a period of drama resulting in whipsawing stock prices. Whilst these three cases are the most notable recent examples of heightened periods of uncertainty which have affected global markets, we see this even more frequently if we are looking at a regional level. I'm thinking of the aftershocks of the UK's decision to leave the European Union, and the ongoing property crisis we have seen in China, to name just two examples. The point is, what we're seeing now as a result of the threat and implementation of trade tariffs is nothing new at all. It's just the latest thing to spook investors and remind them that they really don't know what they're doing, most of the time. The one thing that is common with all periods of stock market turmoil is that investors eventually get over it, notably, typically long before the problem that has caused the panic in the first place has gone away. Never underestimate the ability of the financial markets to readjust and acclimatise to a new economic reality, typically with an altered sense of the degree of uncertainty and risk they are happy to accept. As predictable as sunrise, sooner or later, that cash that they've parked under the mattress will be burning a hole clean through their floorboards, and they will return in droves to the very market conditions that just previously had looked far too risky for them. If we can concede that participants in the stock market as a whole are prone to panic at the very first signs of political turmoil, where does this leave the value investor? Is there something in their makeup that can prevent the overreaction that can lead to bad investment decisions? As we probably all know by now, the principles of value investment, as laid down by Graham, are every bit behavioural as they are about picking the right businesses in which to invest. In his books, The Intelligent Investor and Security Analysis, Graham lays down a framework designed to prevent investors from reacting instinctively to their emotions. It is a natural human emotion when hearing news about a new war or pandemic to panic about how this new reality affects the businesses in which they've invested. The instinctive reaction may very well be, therefore, to get the hell out of there. The Graham framework does not hope to quell that emotion, but it simply teaches the student not to react to it. History shows that even the worst political and economic storms blow over, typically sooner rather than later. To make it easier for the value investor, Graham kindly injects an idea to ease your sleepless nights, and that is the principle of introducing a margin of safety into all investments. Graham introduces the idea that no matter how good we are at valuing a business through analysis, there are always unknowns that we cannot hope to foresee. Through the selection of stocks that are available for purchase at a rate significantly less than their intrinsic value, value investors are taking an insurance policy against the economically destabilising events that crop up from time to time, as well as being psychologically prepared for events that will leave other investors in a state of panic. Value investors will of course have the opportunity to profit from such market turmoil. Great businesses that may have formerly been too expensive may suddenly be available at knockdown prices, offering what may prove to be an attractive entry point. Indeed, without such tumult, opportunities would be few and value investors may very well be out of a job. Ultimately, it must be kept at the forefront of every value investor's mind that it is the confused thinking of the market as a whole that present us with our ultimate vindication. And a reminder to regularly refamiliarise yourself with Graham's analogy of Mr. Market. To conclude, we can say that trade wars and other political events that create uncertainty on the stock markets should hold no fear for the value investor who has studied the Graham approach. Benjamin Graham lays down a solid behavioural approach in his books that, if fully understood and implemented, leaves the value investor immune to the risks of overreaction in relation to destabilising economic events. The margin of safety employed in every investment should allow a good night's sleep in all but the most catastrophic of circumstances. Uncertain times, rather than being something for the value investor to endure, should instead be something for them to profit from. For the value investor relies wholly on Mr. Market's prevailing mood to routinely vary between being too over-optimistic and too pessimistic. Value investors have good reason to hope that particularly uncertain times will act as a catalyst to his emotional derangement. To paraphrase Rudyard Kipling, if you can keep your head when all about you are losing theirs, if you can trust yourself when all men doubt you, if you can meet with triumph and disaster and treat those two impostors just the same, if you can hold on when there is nothing in you except the will which says hold on, then yours is the earth and everything that's in it. And which is more, you'll be a man, my son. With that mangled piece of poetry, I shall draw a close to today's podcast. I do hope that you've enjoyed the show and it has added a little something to your knowledge of the Benjamin Graham approach to value investment. If you have enjoyed it, please do consider adding to playlist. That way you need not risk missing any future editions. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.